Hey everyone, Retire on Dividends here. Here today to make a video about one of the Granite shares, or two of the Granite shares funds. In specific, it's the Yield Boost ETFs that Granite shares launched, quite a ways back. But I'll look at two of the newer funds being NVYY and COYY. So right now, first we'll go through the website, then we'll go through the prospectus, and then do some spreadsheet fun stuff, and then we'll call it a day. All right, so let's get to it. I'm on the Granite Shares website. If you go to obviously ETFs, they have several ETFs, but we're focusing on Yield Boost. As you can see, it still says new because it's one of the newer options that they do have available. And if you scroll down here, you can see the various Yield Boost ETFs, which showing here YSPY, XBTY, TSYY, TQQY, NVYY, and COYY. It does not show launch date, so I'm not sure what is the oldest to the newest fund. But regardless, it doesn't matter. We're just going to click on NVYY for now. And, check out what the website says about it. One thing of note right off the bat, check out this distribution rate. I'm surprised they don't highlight this any bigger. It's a 99% distribution rate, which is pretty sweet. And if you look here, it says the Granite shares Yield Boost NVIDIA ETF NVYY is designed to generate income from option strategies linked to 2x long NVIDIA daily ETF to generate income. Okay, so basically they do options, but not on the underlying NVIDIA, right? They're doing options on the underlying 2x NVIDIA, which would be NVDL actually, which we'll show you in a second. So they are, it's a different fund from what we're used to, different from YieldMax, because again, they're not selling calls, they're selling puts, but they're selling puts on a double leveraged fund. Double the risk, double the fun, double the distro, right? All right, so let's keep going down here. All right, so you can see this fund out, I guess, a decent amount. This is the distribution schedule. If we take a look at that, we look at the, the payouts were as low as 48 cents, as high as 66. Not really too much variation, but again, NVIDIA has been pretty solid, stable, say. I don't know about NVDL, but still pretty consistent distributions, it looks like. Then it comes here, it says the fund objective. The primary investment objective is to seek current income. And then the secondary objective is to seek exposure to the performance of one or more exchange traded funds whose blah, 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 blah. 200%, basically. 200% of exposure of NVIDIA. But they do that through an ETF for NVDL, which is actually their ETF, by the way. You'll notice in some cases they're double dipping, right? they're obviously this ETF is the options ETF, but they're doing options on their own ETF, which I'll show you in a second. So here's some more info. The price, closing price as of this video. Again, today's Saturday, August 23rd. So this would be the close price. Well, it actually shows 821. Should be 822, but it shows 26 bucks. All right. Management fee 99%. Total fee 1.07%. That's broken down on the prospectus, though. Here's the inception date, May 12th, 2025. So, newer fund, obviously, but we'll see how they perform. Here's some documents, fact sheet, this, that, the other thing. I always say you should click on the fact sheet. So, hey, why not? Let's do it. Let's see if it's of any use. Look at that distribution rate, flat 100%. Wow. Okay. Fact sheet. Yeah, this fact sheet's weak, but hey, whatever. Let's go back here. And you can look down here, and I'll show you this in a second too. The Granite shares prospectus here is the original one. But then if you go up here, there was a supplement on May 14th, right? So I have both, open. So we'll go through both of them. But before we go any further, again, the NVIDIA fund, which we're going to cover, and the the coin fund, which we're going to cover, what they do is they both sell options on ETFs that Granite Share owns. So the coin fund does options on CONL. So you can see this is their website. This is their fund, CONL. And of course, and their biggest fund, I believe this is their biggest fund, NVDL. This is what the NVIDIA Yield Boost Fund trades on, $4 billion in assets under management. So there's a lot of people trading in and out of this fund. So it makes sense because their funds are probably the most liquid for the exposure that they're needing to get. Because when they're not as liquid, I'll give you an example. We go back here and we go to the ETFs, Yield Boost. I believe the Tesla one, right? They probably they chose TSLL instead of their fund. Well, let's see. Let me just double check here. So if we go down to the holdings, yeah. So is TSLL, or no, maybe TSLL is theirs too. No, it's not. Okay. So there, TSLR is there. So yeah, TSLL is maybe it's Direction, but yeah. So obviously, and that's an example where they're not using their own fund because they're using TSLL, which is way more liquid on the options premium chain than TSLR. So again, they're not just using their funds just because, they're using them because it's the best option to do so when selling options, if that makes sense. Okay, now let's move on to the prospectus. All right. So what you see here, I'm not gonna, there's so many damn pages here, but they have all the funds all together. So I'm just showing you coin as one example. They're all pretty much the same. They just replace the name of the funds, within. So we'll cover it. And again, expect the other funds to be the same, except different underlines, obviously. So you can see here, it says Granite Shares Yield Boost Coin ETF. Great. Primary investment objective, seek current income. Okay, we know that. Secondary objective, seek exposure. Yep, we know that. The exposure is what? 2 times 200% of the daily percentage of the common stock, Coinbase Global. All right, we kind of know that. Here's the expense ratio breakdown if you were curious. So the fee is 0.99%. However, it says other expenses with a bullet point number 1. You go down here, you could see number 1, other expenses are estimated for the fund's initial fiscal year. So maybe after the first fiscal year, this 0.08% will drop off, and then it'll be 0.99%. But until then, you're going to pay 1.07%. Not sure if you think that's too expensive. I'm not sure if you even care about that 0.08%, but that's just some information that's good to know. All right, under principal investment strategies, again, hopefully this Zoom works pretty good. Actually, can I make it? I can make it bigger. There you go. All right, so again, see current income, 2 times daily. Okay, we know that. It will seek to employ its investment strategy as it relates to the underlying coin ETF, regardless of whether there are periods of adverse market, economic, or other conditions. What does this mean? It just means they're going to do their strategy no matter what's happening in the market. If COVID happens, they're going to do the investment. If tariffs get hit, right? This is they're going to trade. They're going to do what they're going to do. They're not going to stop for any which reason. All right. And that's just all it's stating. And it states here, it will not seek to take temporary defensive positions during such periods. All right. So it basically, although, yes, they did add the ability to buy puts, right? They're just saying, due to different market conditions, they're not going to take, a temporary defensive position based on that, right? This does not mean they don't buy puts, because they do, right? And we'll get into that in a second. All right, here it says provide current income. Okay, yep, great. All right, let's move on. Again, obviously this prospectus is gigantic, but my goal here is just to point out some of the more important things so you don't have to go ahead and read about it. Check out this sentence, very interesting. There is no guarantee that the fund's investment strategy will be properly implemented, and an investor may lose some or all of its investment. Now, that last sentence, well, I guess, I think all of these type of funds have this because it basically covers them in case, especially when you have 200% exposure. What if they only get like 199% in that one day, right? Or what if, you know, again, they rebalance in the middle of the day, or something happens and it's not exact. This just, again, these complex funds, I believe they probably need this in there to save their ass, you know? And then they have here, an investor may lose some or all of its investment. Now, obviously, you may be concerned with the word all, but, you know, again, double leverage funds can be risky. So again, they got to cover themselves because, you know, if the fund goes down 50%, right? Double leverage is 100%. So obviously you hope a fund would not go down 50% in one day, but hey, you never know. And you also hope, you know, they rebalance before then. But again, you just don't know. And that's why they have all of these precautions. Every single risk measure is mentioned in this prospectus. But again, I'm just highlighting the ones that I think are worth looking at. All right, let's continue. The fund strategy will cap its potential gain if the underlying coin ETF share. Okay, so it just says that you're capped on the upside. Okay, sorry to tell you, but you are capped on the upside. But that's nothing new to us high yield income ETF investors. You're subject to all potential losses if the underlying coin ETF shares decline. Now, of course, you are, unless they do buy puts, right? Because sometimes they do buy puts. So, you know, that's up. That depends on the current position. The fund does not invest directly in the underlying coin ETF. So it just means that they don't own coin. All right. They own, you know, they own puts. They sell puts, they buy puts. They don't actually own the underlying. The fund shareholders are not entitled to any distribution paid by the underlying coin. I don't think coin pays the distribution, but I mean dividend. But don't worry, even if they did, you're not getting it anyway. All right, let's continue. Again, I'm just going over what I highlighted. The fund's participation in a potential increase in the price of the underlying ETF only applies if the fund sells in the money put options. Now, this is important to know. All right. And there's actually really, really good examples. I was impressed that they had this entire breakdown, you know, because they don't have to do that. And to be honest, it's very helpful. It's very helpful. And I'm going to go through it. And I think it could be helpful to all of you as well. All right. The fund, it may vary in regard to their strike prices from 40% out of the money to 10% in the money. So it basically is giving them the flexibility to sell puts 40% out of the money or 10% in the money. Okay. 1 week to 1 month out too, by the way, right? I didn't highlight that part. There you go. All right. The fund will enter into a put spread options contract either directly or through swap contracts. Put spread consists of selling a put option contract while buying a put option contract, same maturity, but a lower strike price, maturity being the expiration date, of course. All right, so on and so forth, blah, blah, blah. But now, like I said, these are the examples that they get into, which is pretty cool. I got a coffee here. Let me take a sip. Okay, you ready? All right, example 1, selling in the money put options contracts with a 1 month maturity. All right, for this example, let's assume shares are trading at $100. Okay. They sell an in the money put with a strike price of 105. Again, it's in the money because when you sell a put with a price above the current price, the strike price is above the current price, 105 versus 100, that's considered in the money. Now, for that risk, you receive $550 in premium. All right. So that's good. And obviously, if you're familiar with intrinsic and extrinsic income, $5 would be the intrinsic income, and then 50 cents would be the extrinsic income. So let's take a look here. All right, there's 3 cases here. The underlying ETF share price increases to 105. Okay, so again, you're selling a put at 100 at 105 strike, and it's currently at 100. But this is saying, all right, the share price goes to 105. So what would happen here is you would keep the 550. Great, end of story. Case 2, the price increase exceeded 105. Now, this tells you you would keep the 550 received. However, you would not participate in any additional upside. So again, when they say you are participating in the upside only when you do in the money puts, it's accurate, right? Because again, that $100 to $5, that's you participating in the upside, at least up to the 105, right? And then after that, that's it. That's it, man. You're capity duda. So, there's nothing you could do. Now, in this example, case 3, the price drops. It drops to what? 99.50. Okay. So let's see. The fund would lose money and be exposed to the drop in the underlying ETF price. So again, in this example, we're only selling a put. So again, if the fund does drop, right, under our strike price or under the current price too, and stays under the strike price, yeah, but we're going to lose money. Why do they say 99.50? Well, because again, our strike price is 105. We got 550, and this is 550 less. 105 minus 550 is 99.50. So anything less, we're losing money. We're just not losing money until it gets there because that's 550. We already got that premium worth, right? If that makes sense. Okay, let's go to example 2, and then we'll keep going. So in example 2, they're selling out of the money puts with a out of the money. Obviously, the first example was in the money. So this is out of the money, 1 week maturity. All right, shares are trading at $100, and you sell with a strike price of $95. Again, it's out of the money because it's lower than the current price. And you receive a premium of 50 cents. In this example, since it's not in the money, there is no intrinsic income. This is all extrinsic income. All right, so in this case 1, the price increases above $100. All right, the fund would keep the 50 cents premium. However, it would not participate in the increase of the underlying price, right? Because all we get is that 50 cent. That we get that premium, and that's it, right? If it goes above, any higher than whatever the current price is, sure, our put, is good. We're good, we're fine. However, if it goes up to like 105, we don't go anywhere. We just get that 50 cents, and that's it. So again, limited upside. All right, underlying ETF, case 2, share price drops below 94.50. Okay. Again, why they choose 94.50? Because 95 minus the 50 cents in premium. All right. The fund would lose money and be exposed to the drop in the underlying ETF share price. Okay. So obviously, yes, for anything it goes down further than 94.50, we have to cover that gap. Okay. So we are exposed on the downside there because we didn't buy a put, right? We didn't buy a put. All right. But don't worry. Example 3 has the put that we bought. Let's see. Example 3, defensive strategy, selling at the money, put option contracts, and buying out of the money, put option contracts. Okay. In this example, shares are still trading at 100. Okay. We sold a put, strike price 105. Okay. That's in the money, right? Didn't they say? Yeah, they said at the money, but they're selling a put in the money. All right. Whatever. I'm not going to go crazy on specifics here, and here they bought an out of the money put option contract with a strike price of 95. Okay. So basically this is, think of this as the insurance play, right? They bought some insurance in case the underlying really tanks. All right. The fund receives $5.50 from selling the put. That's good. And they only had to pay 50 cents to buy the put. So in the end, they netted and received a $5 net premium. Not bad. Not bad, bro. All right. So let's see. Case 1, the price increases to 105. All right. So it goes from 100 to 105. So the fund would keep the full $5 in net premium received. This is full capture, by the way, on the upside. All right. Anything above the 105, yeah, that's actually the next case. All right. Here, next case 2, price increases exceeded 105. So again, yeah, you'd keep the 5, but you would not participate in any additional upside. Okay. All right. Let's move on. The underlying ETFs in case 3, price drops below $100. The fund would lose up to $5, which is the difference between the 2 strike levels. Yep. I mean, nothing you could do, bro. Nothing you could do. All right, case 4, price drops below 95, the fund will lose up to $5. So, yeah, I mean, it is what it. Sorry. Yeah, I meant to cover this further. So, if the fund drops to, what is it, 100, the fund will lose up to the $5, right? Because again, we bought. Where is it? Yeah, we bought a put at 95. Okay, if the fund drops below 95, we won't lose any more money. Okay, because again, we got a $5 credit. So, at least the $5 gap from the 100 to the 95, the credit we got in premium wipes that out. So that's essentially, it's a non-loss. It's a zero net effect. But then anything below 95, nothing even happens, right? Because technically we bought a put. If you buy a put at 95, that's protecting the downside. Anything lower than 95, you're good, right? And it says here the fund would lose up to $5. So yeah, again, let's take a look at this. Yeah. So again, let me reread this. The strike on the put that they sold, it was in the money, not at the money, like it says up there, is in the money by 105. So the 105 to the 100, that's the $5 credit. Okay. So then the 100 to the 95, that's the loss of the $5. But that is the only loss you're getting. Anything under 95, it doesn't matter. Your max loss is $5 because you bought the put protection. All right. Sorry if that got a little confusing there for a second. But again, there's a lot of examples, a lot of cases. Yeah. All right. So what else? Types of contracts used by the fund. All right. They use the flexible exchanges. Again, it just gives them more flexibility, gives them more strike prices than what we have available to us. I believe it's like the European Flex Exchange. Okay. So, but that's nothing new. All these funds are doing it. Everyone is doing it. All right. Let me take a sip of coffee. Got to wake up. It's my third video today. All right, swap agreements. What do you got? Swap agreements used by fund. Fund may enter into swap agreements with major financial institutions that provide the same exposure as the selling put options. Interesting. So they could do a swap agreement that replaces the put option? I don't think I've seen that, but that's interesting. All right, underlying coin ETF, daily leverage investment results 2 times 200% of the daily percentage, blah, 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 blah. Okay, great. So again, it just mentions they do daily rebalancing. It's not good to hold it for a period longer than a single day. They always say these are not long-term holds because they rebalance daily. All right. And then it says here, Granite shares 2x long coin daily ETF. Again, CONL. This is what they trade, which is actually their fund. So you can call that double dipping, but at least we don't have to pay both expense ratios, right? We just have to pay the one. Okay, what else we got? That's actually it. From here on out, I'm not saying this is not important. I'm just not going to read it to you. But this is where they talk about the risks. Underlying coin risk. Obviously, you have risk on coin, right? Derivative risk, affiliate funded risk, counterparty risk, price participation risk, distribution risk. All right, I'm too exhausted, but this is all the different risks. And you feel free to check that out. All right, and then we get here, and then here's the next fund. Because again, they put all the funds in the same prospectus. And if you want to read every single fund's prospectus, be my guest. But I'm not doing it. All right, and then I mentioned there was like an amendment to the prospectus. So you can hear this is like a supplemental prospectus. So if I go here, do we care about this? Let's see. It's dated May 14th. I think the other one was dated March. Well, it says it's effective June 1st. It says the fund seeks to provide current weekly income. There is no assurance that the fund will make a distribution in any given week. Interesting. So maybe that wasn't there before, and maybe they just want to say that they may not make a distribution. All right. Let's keep going. If the fund makes distributions and the amounts likely vary, yep, we know that. Additionally, the weekly distributions, if any, may consist of return of capital. Well, duh, which would decrease the fund's Okay, whatever. It's just additional information to cover their butts, right? They have to cover their butts on this. And obviously that's why they have the prospectus, and I'm sure they have lawyers that do all that fun stuff, right? That's why we can't read the whole thing. It's way too much work. Okay, last part of the video. Now we get to have some fun. Now we get to look at spreadsheets, right? That's so much fun, isn't it? So again, some of this is a little screwed up, but I didn't have time to really care or fix it. But we really just want to know like how it would work. Now, right off the bat, I mean, you couldn't launch at a worse time. Right now, look at this. NVDL from May 12th, because again, it launched May 12th, to May 13th, although this is actually open price May 13th, to the end of day May 13th, NVDL went up 7.7%. The next day, it went up 8.38%. Are you kidding me? Are you kidding me? 16% gain. And again, we know they are limited on the upside capture, so there's nothing they could do in days like that. Those days are killers, man. Those days are killers. So they only captured 0.51% because that's basically, again, the premium they made all the premium. They kept all of that premium. They didn't lose the contract, right? That was 100% profit on the contract, right? But it only paid, they only made 0.51%. So that's a huge, huge hit. But similarly, we can't look at that day because it's not even updated. Let me find a big down day. A lot of gaps here. All right, so here's a down day, down 4.24%. All right, so it dropped 4% in one day. NVYY dropped 0.21%. So yeah, I mean, again, that's luckily they probably bought a put, so they protect the downside there. But maybe here they didn't. Here's another day, down 2.38%. NVDL went down 2.47%. All right, so I don't think this must not be picking up the right X date now that I think about it, right? 620. If you look at 620, yeah, it was a Friday. I don't know. I'm not sure, but I'm not going to focus then on those X dates. But let's look at here. Here's a non-X date, I think. All right, so NVDL went down 5.77%. NVYY went down 3.17%. So, yeah, man. It doesn't go down obviously as much when they do buy the puts. So that's the good part about the downside protection. All right. What else? Let's see any other big days. Again, here's a big jump day, 7.95% up. But look at this. They captured 2%. So they must have had like an in the money put, right, on that date. So we assume at least. Big dropped 5%, went down 2, then went up 4, went up 2. So if you look, you add the 2 days together, NVDL went down 0.63%. Let's see what NVYY did. They went down about the same, actually. So, okay. And then again, another big 7% day. That's the problem with these double leverages. And if we're going to be capped on the upside, they have big swings. You're going to get screwed. Obviously, we're protected on the down, but we're not protected on the up. So what can they do to capture more upside? Maybe that's a question we should ask Will Ryan, which, by the way, if you're watching this video today, Saturday, I'm having Will on Monday morning. Obviously, if you're watching after that, after the Monday, then it's too late, but all good. All right, so before we get to the bottom, I just want to show you the yields, what kind of yields we're looking at. 126%, 129%, 113, 94%. So the double leverage is crazy and the yields are crazy. Again, take this for what it's worth too, because some of the prices were not filled in. But it shows that NVYY per day, they had more wins than NVDL. However, NVDL had more big wins, all right? And you could see that by over here, the capital gains percentage, appreciation-wise, 47% NVDL went up. And there's nothing NVYY could do. They only went up 2.92%. However, they did get a distribution. So if we add that, they actually did go up 23%. 0.78%. And if I included drip, which this does not, that would be even greater, which brings it much closer, obviously, to this number. But again, NVDL had a lot of big swings on the upside, which again is hard to capture. All right, sorry about that. Before we jump to CONL versus COYY, I just want to show you what the holdings look like. May have to zoom out actually. All right, so view, freeze, one row. All right, so on the top, they're holding cash, T-bills. Okay, great. So here's an example of them, buying a put, and then here's the example of them selling a put. And how do I know that? Well, again, if it's a positive amount, it's actually worth money. So the put that they bought right now, this one is worth $29,000. Of course, this is as of Friday morning. It didn't update. Obviously, I'm making this on the Saturday. I don't see Monday's holdings, but maybe they'll update that on Monday. But yeah, in pink, they're selling a put. In this example, 355 contracts, 91.36 is the put, and then they're buying a put, lower strike price 82.22, and that way, in case it drops below, down below, then obviously this is going to be worth. This will protect them essentially. Right now, you can see it was worth, at least as at the time of this download, $29,000, and then this cost $258,000 at close. Continuing, again, they have, here's another 90.90. It looks like they have protective puts on every position, at least on this fund. So they are protecting their downside, and I think that's a very good idea, especially with a double leverage fund. And you can see the out of the monies here and how they kind of work. But again, these will be all outdated by the time the video comes out. They're outdated now anyway. All right, the assets under management, 82 mil. The NAV, 25.55. Closing price, 26.33. Why is that? Maybe ex-dividend date, not sure. But anyway, let's move on to CONL versus COYY. Somewhat of a better comparison, actually. Now, right off the bat, kind of the reverse, right? CONL actually dropped bad, 6.3%. COYY, yes, they dropped too, but only 1.75%. So they must have had the protective puts on the first day, which is pretty good and helped them out. But then the next day, CONL recovered. They went up 3.17. COYY went up 1.45. So it is what it is, right? Here's a big down day, down 33%. Man, I did not include if CONL had distributions though, so I got to keep that in mind. So let's actually, maybe this is a better day. Down 12%. COYY went down 6%. Okay, so again, protecting the downside. That's still a big down day. That still kind of hurt. Here's a big update, up 5.74%. COYY only captured 1.4. So hey, what can you do, man? Again, very short period here. They just launched in July. Here's a day down 11%. COYY went down 4.5. So, overall, actually, COYY did better than CONL. So here, COYY 15 wins, CONL 10 wins. And this captured all of them. So this is actually accurate. Now, if you look at capital appreciation overall, CONL during this period, they went down 54%. But again, coin had a rough outing during that time. And luckily, COYY only went down 19%. If you add back in the distributions, though, they actually only went down 12% versus CONL's 54%. So again, in the other comparison, the double leverage fund did beat the income fund, but not by much, right? Because again, we did not have drip shown. And in this example, the income fund whooped the leverage fund, right? So obviously, yeah, if the leverage fund, if it goes downward, then yeah, the income fund will beat it. Or if it trades flat, the income fund will beat it. But it's when you have the big upward shifts where, again, we're going to be limited on that upside, if that makes sense. Okay, and now we're going to look at their holdings. Not as colorful. I didn't highlight these specifically. I didn't even really get a chance to do too much digging on this, but the bottom line is, yeah, they have protective puts, right? If you have the pink, you got the I'm sorry, the pink is the sold put, the green is the buy put, all right? So they have a protective put for every single position, right? You see them selling a put, what, 35, buy a put, 31, sell a put, 31, buy a put, 27, right? So again, just protect, and they're scattering their strikes, which is really good too. Again, I don't cover these on a daily basis. They don't post their intraday trades on a daily basis. But if they did, would anyone want to cover their, I would think so. I would honestly think so. It won't be me because I don't have the time, sorry, but maybe one day, you never know. But honestly, this would be a pretty good fun to cover. I would have fun doing it. I would. But it's just, I wish I had more time. I know. All right. Anyway, so obviously we have the various strikes here broken out. Yeah, the monies, no need to go here. I will share this spreadsheet, guys, if you guys want to see it. I have no problem doing that if you want to see it. And feel free to chime in if you think I made an error, because obviously that's possible. All right, assets under management. I'm showing 40.3 mil NAV, 1957. Closing trade price 21. All right, so again, maybe ex-dividend date. That's why there's such a big gap, but I don't know. Could be, could be. All right, so that's basically it. Again, we go back to the website, we could pull up, what are our thoughts, right? So we had, what fund was this? This was the Tesla fund. Let's go look at the COYY fund, not the COYY fund, the Coinbase fund. All right. Loading. All right. So again, this fund recently launched. Let's check out the distributions, any type of consistency here. 84 cents, 72 cents. Okay. So yeah, man, they're pretty consistent too so far. So maybe that's a good part. I know in the beginning they were paying monthly. They did trade. They did change it to weekly. And I think that was a big thing. And a lot of people do talk about these funds. And they, oh my God, look at this distribution rate, 179%. Good Lord. Wow. So again, this carries the individual underlying risk, right? But not only that, the double leverage that. It's a 2x risk. However, would I invest in these funds? I currently do not, but if they offered a fund of funds, yes, absolutely, I would, just to limit the exposure to one underlying, all right? Because I do think it's an interesting strategy. However, if you don't like being capped on the upside, well, then good luck. But again, that could be a question we could ask them. How do you plan to capture more of the upside? The downside is not their issue. Again, they got that down, especially with double leverage fund, man. It's awesome. It's actually really good. So if the market trades down or flat, they're going to do well. These funds will do well. But yeah, man, I don't know. We'll have to keep an eye out for them. I know there's been such demand on these funds. Can you cover them? Can you cover them? But yeah, they are different. They're different from any other competitor. I don't know of any competitor doing a similar strategy. And then look at this. They have YSPY, right? So that's cool. Then Granite shares QQQ. So they do it on the SPY and the Q. So yeah, let's check out the SPY one actually. Oh, damn. They do 3. Oh, that's a beauty. That's awesome. Do they use UPRO? SPXL. Okay. Wow. 3X. 3X. That's awesome. I didn't even know that. I should have covered this fund. Wow. Right up my alley. 3X. I wonder if they do the TQQQ fund. Let's go check it out. Let's go to Yield Boost. Where are we at? Here it is. Loading. I know it's very slow. Sorry, sir. Let's see. Yep, 3X. Let's see the holdings. Yep, TQQQ. Wow. Awesome. This is freaking amazing. Oh man, add them into the fund of funds too. They don't do a Russell though. We got to ask about that. TNA, do it on TNA. Oh, that'd be a sweet ass fund. But yeah, I love it. I love playing the leverage. I love it. I mean, obviously, these are super risky, and you guys know that. But it's just interesting, and it's a different play. So again, I'm just happy I'm able to go over these funds. Spend some time doing so. I did go over them in the beginning when they first launched, but again, it's good to redo it on occasion because a lot has changed since then as well. All right, guys. As always, this is not financial advice. I am not a financial advisor, clearly. This video is just for fun and entertainment. I really hope you had fun. I really hope you're entertained. If not, I'll try again next time. Don't worry. If you enjoy this content, please hit the like button. If you have any questions or concerns, leave them down in the comments below. Outside of that, I don't know what to say. I just want to know your thoughts. What do you think of Granite shares? Do you have an opinion? Do you invest in Granite shares, and which fund and why? If they launch a Russell 3X fund, will you invest in that? By the way, I didn't even check out the Bitcoin one. Let me check that out before we go. 2X. What do they use? BitX probably. 2X Bit. Yep, they use BitX. All right. Awesome, man. Awesome. I love it. But again, you don't want to cap your upside on Bitcoin. That's the problem. But yeah, man, crazy funds. I love it. I love the competition. I love the variation. I love the different strategies. It's just we're living in a good time, man. Good time with a lot of options, and it's really amazing. Different tools in the tool shed for us to play around with. But like I said, let me know what you think of these products. Let me know how you think the review went. Let me know if you have any further questions. But again, if you're watching this before Monday, the 25th, August 25th, come join my live stream at 6 a.m. Monday morning. The morning show with Rod. We'll be having Will Rind on, and it'll be a fun old time. Community interview, baby. So if you guys have questions, bring them up then. All right. I'm going to end it here. I'm out of here. I just want to say I appreciate all of you for watching. It means a lot. So let me know, your feedback on this, and we'll discuss any other funds you want me to cover later on. All right. Have a good one, and I'll talk to you all later. Peace.